Hello everyone. Topic of today's video is before you invest in Match Group Inc., ask yourself. I will explain to you in what I mean in 3 steps. Step number 1, let's calculate discounted cash flow, intrinsic value of company Match Group. You can see probably right now here my calculation for discounted cash flow. I put there some figures and I discounted cash flow for 10 years. And then of course I took certain calculation in perpetuity. If you're interested in how intrinsic value for discounted cash flow calculated, you can go into my previous videos, one of my previous videos. I will post link in the description. The figures I took for this calculation taken from the website Macro Trends. It's an easy, simple way to gather all the figures without going to each report, annual or quarterly report separately. Excuse me. And basically I came to the figure of $60 US, $61 per share as an intrinsic value, considering the premise that Match Inc. will grow by 10% in the next 10 years, which is extremely optimistic figure. So I normally take very conservative figures. In this case, I took optimistic figure just to show you how drastic the difference between the intrinsic value calculated based on discounted cash flow and the actual price today on the market. The price actually taken from 28th of May, $143 US per share. I also took interest rate. As you know, right now in the United States, interest rates are nearly zero, and many people think that they will stay there for a long time. What will eventually, so it cannot be two ways. You either get a higher interest rate and price of the stock market goes down, because you compare now stocks with bonds, for example, where you can safely earn, if interest rates goes to 7%. It means you have less risky asset you can invest in with a high return. Of course, there are a huge problem in the United States with debt. That's why they cannot raise interest rates. And if they keep printing money and at the pace they're doing right now, with all those fiscal and monetary stimulus, most likely it will bring us United States to inflation. And that's why I just took 3%. It's again very optimistic figure. And this 3% in the 2021 and 2% every next year, consecutive years, reflects either interest rates rise or inflation. And again, in my opinion, my personal opinion, it's a very optimistic figure. It must be much higher. Either interest rates must be much higher, 12% maybe, to break the neck of inflation, or the inflation will run so hot it will be much higher than 2%. Anyways, I took optimistic growth rate and I took optimistic interest rate. So this $60 US is extremely optimistic price. I just took it for this example because I wanted to show even with this extremely optimistic premises, the price is still more than 100% higher than intrinsic value of discounted cash flow. That's the step number 1. The step number 2, what is behind Match Group figures? On this, again, cash flow information, you can see that the cash flow of Match Group had been growing. So the net cash, as they say it, and I'm pretty sure it's not GAAP, not generally accepted accounting principle measure, because you normally would take, you have cash flow from operations, from investing, and from financial activities. So this, I guess it's a representation of the free cash flow. Free cash flow would be operational cash flow minus capital expenditure. So it grows. They show very good positive growth for their investors. So that's how they try to make investors interested. Of course, what happens in another 2 categories, statements, cash flow from investing, you can see that it's It looks normal in 2018, 2019, but then it goes up, way up in 2020. And that might be caused by various reasons. You always need to dig deeper what is behind the figures. So in this case, it's an acquisition, which I will show in the next slide, after a few slides. And then you can see the financial activities. Financial activities is usually repayment of debt. And usually, normally, it's a negative figure. In this case, 2019, 2020, it's a positive figure. It means company took on debt or issued stock, and that's why cash flow from financing activities is positive. Normally it's negative. In this case it's positive. It's also another reason why you should look a little bit deeper into that. Why is it positive? It's not normal for most of the companies to have this positive, and you need to understand why it is positive. It's not necessarily a negative thing, you just need to understand why. In the next slide, somewhere on the screen, you will see shares outstanding. Shares outstanding from Match Group had increased significantly in the past years. You don't see the scale, but it's quarterly, and every 4 columns basically, it's each quarter. The last quarter is first quarter 2021. You can see in the last few years, shares outstanding increased dramatically. It's the shares on the market available to buy for Match Group. So the question, where did they use this money from issuing new shares? Why did they issue new shares? Because when they issue new shares, you dilute investment of the current investors. So why did it happen? Next note, assets recognized from the cost to obtain a contract with a customer. The company has determined that certain costs, primarily mobile app store fees, meet the requirements to be capitalized as a cost of obtaining a contract. The company recognizes an asset for these costs if we expect to recover those costs. Mobile app store fees are amortized over the period of contract performance. Specifically, a company amortizes mobile app store fees over the term of the applicable subscription. So that's a very important thing to ask. You can see that those costs represent more or less half of your free cash flow for the company, and your free cash flow is the basis for intrinsic value calculation if you use discounted free cash flow model. So what it says here, that company took costs which seem to be normal operational costs, the app store fees, and some costs which are operational, related to normal daily operations. They took them in investment section of the cash flow, and they put them on the balance sheet as an asset. And if they would take this as a normal operational cost, then it would dramatically reduce by 50% your free cash flow. So that's the thing also worth looking into a little bit deeper. Is it legitimate that they actually did that they took it into investing section and they put it on the balance sheet as an asset? Or do you think that mobile app store fees supposed to go to the operating section and be normal operating cost? That's a valid question to ask. On the next slide, you can see in February 2021, the company entered into a definitive agreement to acquire HyperConnect Inc., a leading social discovery and video technology company based in Seoul, South Korea. So they purchased this company from South Korea. It means the cash they raised with share issuance through debt is used to acquire new companies, or in this case, one company. And then in the next slide, again, here, you can see that they actually acquired multiple companies in the past few years. So it means the business model of Match Inc. is not organic growth, but growth from acquisitions. So instead of investing their own capital or spending their own operational cash, they use investing cash or financing cash in order to finance their acquisitions. So they buy new companies. The question there, how profitable those companies they acquire, and if this growth they show every quarter, every year for the past few years is sustainable. If you look again at the original discounted free cash flow calculation, you will see their revenue and net income. I will put it again here. So you will see that company Match Inc. grew in the past years by 37% 2017, 96% 2018, 8% 2019, 20% 2020. So again, you can see that they created a lot of growth, which currently on the stock market is very valued quite a lot. A lot of people are investing in company with growth who don't even have positive cash flow or earnings. You can take Uber, which loses money every quarter, billions of US dollars. But many people invest in Uber and it has a huge capital cap because it's growing. So people expect that in the future they might get out of this company something much more than they invested right now, even though right now they don't make any money. And it's also related to interest rates, which are very low right now in US, but it's whole another topic for another video. Now we go to the next slide. And this is the financial statement from the spin-off of Match Group. So company Match Group now separates company IAC as a separate entity which can be traded on the stock market. So basically they want to earn money with this AC spin-off. And you can see the financial statement from IAC here in this slide. And you can see that their earnings in 2020 were negative, and 2019 were much lower than 2018. Another question, do they really lose money? Did they really lose money in 2020, and did they really have reduced earnings 2019? Is it organic, or is it something what was tweaked by Match Group in order to depress their earnings in the previous year in order to show the better earnings in the next year when this company goes public? So that's an instrument which many companies use when they try to promote something, that they depress their earnings, cash flow before it goes public, and then all of a sudden when it goes public, it shoots as a very profitable cash flow rich business. And that of course boosts the stock price way up. It's another question which you need to ask yourself and look into Match Group. This type of spin-off just shows that the company might not be 100% fair with the shareholders. That's the thing you need to check and ask yourself. The next is the Match Group subsidiaries consolidated balance sheet. On this balance sheet you can see the assets, and the main assets in the balance sheet of Match Group are goodwill and cash. Cash, we discussed previously that there are some questions to be asked about cash of the company Match Group with respect what they put the operating cash section, what do they put in investing cash. And now we are talking about goodwill. Goodwill is the difference between the net asset of the company acquired by Match Group and the price they pay. So it's not real value, it's not real, it's not something real you can check, except for they do the discounted cash flow model for those businesses, and auditors make sure that this calculation was made correctly. But again, the assumptions they make for discounted cash flow model might be completely out of range. Auditors don't really know which assumptions are correct, so they put it usually in the critical section in the annual report. So this goodwill through the multiple acquisitions might not be a real value. That's another thing you need to look deeply before you buy companies like acquired stock of the company like Match Group. So those two main assets are under question, to say the least. Now liabilities, I don't know where I put it. It's a pretty big one. You can see that long-term debt is growing significantly. You need to question why a company with rich cash flow and earnings takes so much debt. Why do they expand so aggressively? Can they really sustain this growth if not for acquiring those companies? Are those companies they acquire profitable? That's a big question to ask. Another two things in this liability section which I see just out of range: additional paid in capital. So that's the additional issuance of the stock. That's the money they raise with the stock. Retained earnings minus 8.5 million in 2020. That's something you really need to look into. Where this retained earnings in such a huge number coming from? The whole equity of the company, if it's not for the additional issued stock, would be even more negative. And negative equity for the company, it's a bad sign. Profitable, good, reliable business not supposed to have negative equity. They should not have so much debt that they cannot service themselves. They always can take more debt, and in US right now it's easy because we have low interest rates and you can take just more money, and you can kick this can down the road as many companies do without earnings or cash flow. But eventually you need to ask yourself, is it sustainable and is it one day going to collapse? That's the big question here. So long-term debt represented by senior notes. You can see it again on the slide. Multiple senior notes issuance. I'm pretty sure those were issued for acquisition of the other businesses in order to show this inorganic growth, in order to show this acquisition growth. And a few last slides on this step number 2. Company uses non-GAAP metrics quite aggressively. EBITDA, which is earnings before interest, tax, depreciation, amortization. It's a very bogus, to say the least, metric. It doesn't really show you the real earnings of the company because it's before depreciation, amortization, which are normally the main cost categories in the on the balance sheet. That's really misleading metric, as well as company uses in the next slide. They show how their stock performed, and this obsession with the stock price, it's unhealthy. Company not supposed to be so worried about their stock price. They are supposed to be worried about their business, about the profitability of their business, about the healthy cash flow, healthy growth. If they care so much about the stock price, it might give them wrong incentives, because it's always easier to just acquire new businesses, buy new companies, instead of investing in your own research and development and growing organically. It will boost your stock price in the short term. There are multiple examples in the history, company Tyco, for example, if you're interested, where this obsession, these wrong incentives brought companies to brink of bankruptcy. Because the businesses they acquire, companies normally pay for those businesses much more than they would if they would develop this product organically. And these companies might look much better right now when they were acquiring them than they really are. They might not be as profitable or not profitable at all on acquisition, but they temporarily boost this cash flow. And if company gets this boost and continually buys more companies by boosting its operating cash flow and revenue each quarter, each year, then for some time they can keep rolling and they can show that they are a strongly growing company, where in the fact it might not be the truth. Step number 3, ask yourself, be skeptical. Looking at all those figures and notes from Match Group, you can ask a few questions. Is acquisition growth of Match Group sustainable? Are the growing earnings and cash flow legitimate? By legitimacy, ask if they were reflected correctly. If the figures you get from the growth of the company are legitimate, or it's a temporarily one-time boost which they get through the acquisition. Are the interest rates going to stay at zero with a low level of inflation at 2-3%? That's what Federal Reserve currently is saying from US. You need to ask yourself, do you believe in that? Do you believe that with this stimulus in monetary and fiscal stimulus and the current level of interest rates, zero, do you think inflation will not pick up and you think that interest rates will stay at zero forever? Or maybe there's some change coming and you need to consider this macroeconomic factor in your calculation and valuing the business. Long-term debt is sustainable. With the low interest rates, the answer would be most likely yes. But then again, it depends if the company still generates cash flow and this company is still profitable. Because long-term debt is always a red sign. You need to be very aware, especially when it exceeds the current cash on the balance sheet. So you need to look into that deeper and ask yourself those questions. Why does Match Group use misleading non-GAAP metrics like EBITDA and stock performance? Company is supposed to act with candor. They supposed to openly and frankly speak with their shareholders and give the business situation like it is. Misleading metrics give you a red sign with regards to the company you're investing in. The final question to ask yourself, is Match Group considering discounted free cash flow, intrinsic valuation, and aforementioned questions a good investment? So that's what you need to decide for yourself. Just looking into all the facts and figures, you need to decide if it's a good investment, if it's investment for you, if you understand this investment, if you think that business will grow and that business will thrive and that all the politics and all the measures taken by the management of the company are correct from your point of view and will bring this company to a better place in the next 10 to 100 years. Thank you all for watching this video. Like it if you liked it, and bye for now.